Hey there, everyone. Happy Friday, June 14th. I'm Dave Keller, Chief Market Strategist here at Stockcharts.com in a beautiful Redmond, Washington. And thanks for joining me here today for the final bar. This is a special all mailbag edition to wrap up the week, answering some of the great questions we've received in the final bar mailbag in recent days and weeks. As a reminder, the mailbag is always open, so any questions you run into as you are analyzing markets, as you are trading using technical indicators, as you are trying to digest all the noise and all the information around you, trying to make good investment decisions using technical and behavioral tools, we are here to help. Email us your questions at thefinalbar@stockcharts.com. I hope to answer one of your questions in our next mailbag episode. With that in mind, let's get to question number one. Dave, you've shown the symbol to SPY panel with the y-axis displayed as a percentage. How can I recreate this? So I love the question mainly because I love when people watch stuff on Stockcharts TV, read some of the articles that our contributors put out on the Stockcharts.com website, and then try to recreate it in their own login. We are very much looking for the tinkerers, looking for people trying to come up with different ways of analyzing things, trying to manipulate the charts and think about how to set them up differently, save your favorite styles and your favorite lists, or your favorite charts into chart lists, and work with the platform over time. I think that's where you can really elevate your understanding of the markets, your awareness of what's happening around you, and hopefully that maps to better returns and more consistent returns, and certainly better decision making. I think you're referring to this panel at the bottom. My sort of default chart has the stock or whatever ETF I'm looking at below a full quote, which has a lot of good information about basic valuations and dividends and market cap and stuff. I have price with moving averages for the last 2 years. I have RSI, which is my favorite measure of momentum. And then I have relative strength or relative performance. And out of all the things I show you, that is arguably the most important because it really helps you understand whether you're looking at the right chart in the first place, right? It's all about the performance of this thing versus all the other stuff that you could own, mainly in the form of the benchmarks like the S&P 500. The way you do that is there's an indicator in Sharp Charts, which is the platform I'm using here. Our ACP platform, our advanced charting platform, has an indicator called price performance. There's also one called, what is it called? It's something about relative strength, and forgive me for not remembering off the top of my head what it is in there. I think it's relative difference or something like that. But there are a couple different indicators that allow you to do this comparison. Look at one thing versus something else, and instead of quoting it in a value difference, which is what most systems default to, we show it in a percentage term, which is a little more valuable. So you want the indicator called price-performance, and then you want to use this syntax. $ symbol means whatever I type up here, whatever I type in the top, it's going to insert that as the numerator, and then the denominator, make it whatever's most meaningful to you. I tend to use SPY because that is sort of the default benchmark that I like to use. Grayson Rose here at Stockcharts uses VTI, which is a broader ETF covering a broader list of equities. Whatever is that benchmark that you're trying to do better than as an active investor, that's what you want to put in as a denominator. If you don't have a good answer for that, use the SPY or the VTI. I think either of those are decent ways to do it. Generally speaking, you want to own things where that relative line is going up. You want to not own things where the relative line is going down. If you could do that consistently, you're going to outperform the benchmarks by definition. Great question, by the way. Question number two, if we have seen the Hindenburg Omen, why would we still be opening new positions as opposed to going to cash? Fabulous, fabulous question, and I love that. And it's not lost on me that we have different ways of thinking about the markets, all of us, right? And as I'm talking, I'm going to bring up the Hindenburg Omen chart that I like to share. Just breaking down the Hindenburg Omen and some of the components. I have a breadth indicator list, and I'm going here to Hindenburg Omen components. So the Hindenburg Omen did give an initial sell signal at the end of March. That's based on 3 different indicators: the New York Composite Index rate of change, new highs and new lows, which have to be above a certain threshold, and the McClellan oscillator has to turn negative, which means that breadth conditions are weakening. When you get those 3 things together, this composite indicator flashes at a positive 3, tells you there's an initial warning. You need to have multiple signals within a month to validate that Hindenburg Omen sell signal. And I've highlighted here the last 3 times that it's occurred. Generally speaking, most major tops have had a Hindenburg Omen signal not after the top, but usually going into the top. It's sort of a great early warning system that the conditions are looking similar to previous bull market topping phases. So I did a video on this on my own YouTube channel called Market Misbehavior. I would encourage you to review that over the last couple weeks because we break that down in a little more detail, talk about the methodology and what to look for. Your question is more about, like, if that is what the market's telling you, why are we even talking about stocks at all, right? Shouldn't you just be going to cash, running for the hills, burying your money in the backyard? Yes and no, right? And I guess the way that I would think of it is a couple different ways. As a trend follower, I want to follow the trend. And as long as the S&P keeps making new all-time highs, I'm going to want to have exposure to the S&P making new all-time highs. So the Hindenburg Omen is certainly an early warning system. It tells you when conditions are very similar to previous market tops. For me, that initial Hindenburg Omen warning sign plays in very well to, I think, what has been the story over the last 5 years, which has been a pretty significant market top in the summer. And it's not always been in, June or July. It's been somewhere in there. We've usually had a pretty significant top to deal with. And so this, for me, tells me we're getting near a top, but it's not necessarily a great timing tool, right? The Hindenburg Omen is not meant to tell you about the next day or even the next week. It is a process that takes weeks, if not months, to actually form, right? Tops are a process, not a moment. So I'm still going to want to have exposure to equities as long as they keep going up. For me, this just tells me to be a little, be wary and be ready and be looking for signs of deterioration. There are other things that I look for, like bearish momentum divergences, like breadth conditions deteriorating, like stocks failing to hold support levels, right? Actually showing deterioration. We're not really seeing enough of that yet to confirm that a major top is happening today or tomorrow. So I think for me, whether or not we see a Hindenburg Omen, I still want to own good charts. And it's always a good time to own good charts. So make sure you focus on actionable ideas. For me, if the market does turn lower, I have a momentum model that I use with my own personal investing and my own portfolios. I'll naturally allocate away from equities and into more conservative things through ETFs if I get that signal that it's no longer the place to be. But for now, stocks are still dominating, so we're still in an uptrend, as evidenced by new all-time highs again this week for the S&P and the NASDAQ. Really good question, by the way. Before we get to question number 3, just as a reminder, I have a free webcast coming up next Tuesday, June 18th, called Mastering Fibonacci Retracements, Unveiling the Golden Ratio. You can sign up for that free event at marketmisbehavior.com/Fibonacci. If you've always wondered about the Fibonacci ratios that I occasionally show on the show, if you've heard of them and never really understood how to implement them, hopefully our time together should get you pretty well equipped to apply those Fibonacci retracements to the charts of stocks and ETFs that you are interested in. Again, sign up for that free event at marketmisbehavior.com/Fibonacci. Question number 3. Is RSI meaningful for relative charts such as XLY to XLP? That is a fantastic question. I love how you're thinking about, whether different technical tools can be helpful, whether they can be applicable, just trying to get a sense of where they work and where they don't. I very much respect that question. Here is the ratio that you're talking about. I like to call this my offense versus defense ratio. When this ratio is going up, that means offense in the form of consumer discretionary is outperforming. When the line's going down, that means defense, consumer staples, is doing better. It's a great way of just measuring sentiment as rotating between consumer discretionary and consumer staples. Now, the equal weighted version of that ratio has really popped higher over the last couple weeks. You can see it actually, testing the upper end of the range for 2024. But what you're asking is, and instead of that, can I just do an RSI like this and use the RSI to analyze the ratio? So the answer is you certainly can. And to be honest, earlier in my career, back in my Bloomberg days when I worked with a lot of institutional investors, I spent time a lot of hedge funds in the Northeast, in New York and Connecticut. I worked with a number of hedge fund traders that would actually do pairs trades, and they would use RSI. Pairs trade are basically when you're long one thing and short the other thing. And what you're basically doing is you set up a ratio, and you're basically betting on this ratio going up or down. So it's a market neutral strategy. It doesn't matter necessarily what the broader market is doing, or in fact what either of those individual stocks or ETFs are doing. You're just betting on the relationship changing. What they would often do is look for signs when when the ratio was, with the spread was much tighter and much wider than normal. And so they would run RSI on a spread. So just one thing minus the other. They would run it on a ratio like the XLY to the XLP and just look for signs of that ratio becoming overbought or oversold. Now, is that done as much as it is on individual stocks? Absolutely not. I would tell you, for me, I'm not as much of a fan of applying momentum indicators to ratios. I don't use that regularly in my own work. I'd much rather be interested in just the trend reversing. So I look at things like moving average reversals and breakouts and breakouts to indicate a change in that configuration. However, it is a well-documented strategy to use indicators like MACD or PPO as a trend following device, RSI and other momentum indicators as a way to gauge whether those ratios have really had an exaggerated move one way or the other. And in that case, you're basically betting on mean reversion. You're betting on a spread that has widened up excessively to come back in, a spread that has become very tight to widen back up to normal ranges. It's about mean reversion, right? Reverting back to that average relationship. So why I don't personally use that in my day-to-day work analyzing ratios, it is a well-documented approach. I would encourage you to experiment. I think RSI is a really good one. My only suggestion, if you do use something like RSI, make sure you think about the settings, right? 14-day RSI for a particular spread or ratio may not be the best setting for the way that you are trying to analyze them. So don't be afraid to bump it down to 9 or 5, bump it up to 21 or something if the signals are too noisy or not noisy enough. Next question, how do you analyze SPXL versus the underlying S&P 500? Really interesting question. I actually brought up the SPXL here. If you're not familiar, that's a triple long or a 3-time long leveraged ETF playing on the S&P 500. So quick thought here, and I'm looking at the weekly chart here. You had a much longer question which you shared with me, which is basically, here's the SPXL, the triple levered S&P 500, and it is currently at all-time highs from 2021. But if you look at the S&P 500 index, we're already way above the 2021 high. So what's up with this discrepancy where the SPXL is not to a new all-time high, but the S&P 500 itself very much is? Here's the thing, right? The SPXL and other leveraged ETFs are, and ETNs and other related items, anything that's leveraged or inverse as well, they use other things, right? They use interest rate swaps and other derivatives to try to recreate, to get certain exposure and to basically create a synthetic triple long S&P, but it is mapped to the daily return. So the intention of this ETF or ETN, whatever this is to basically have a triple return. So if the S&P is up 1% on a given day, SPXL should be up about 3%. Not perfectly, because there's a bit of a mapping error between the two, but generally speaking, it maps pretty well, particularly with liquid things like that you're seeing here. However, it is not intended to match returns over longer periods of time, and that's how the math actually works out, right? If you match the the returns up and down at triple times, the daily returns will match, the daily percentages will map up as expected, but over time, there's a decay that occurs between the leveraged ETF and the underlying item. And it's often a mistake that I find that people run into is you're expecting this, from point A to point B to have triple the returns. It's actually not trying to do that at all. So over time, those returns will deviate most likely more and more because of that error. They will become more and more disconnected to the long-term returns of the underlying asset like the S&P. What you have to remember is those ETFs and those ETNs, those leveraged ETFs, were really intended to be used on short-term timeframes, 1 day or less, to try to mimic that return. A lot of investors are using them to juice their returns over the long time. And all I would say is that's totally fine as long as you understand the risk, as long as you understand the exposure and all of the challenges you may face with a leveraged product, but also understand that it won't map the long-term percent returns that you may expect because of that mapping difference, right? It's trying to map to an individual day's return and not longer-term returns. So the other thing you asked about was, what do you analyze? I would never analyze a leveraged ETF and do technical analysis on the leveraged version. I would always use the underlying instrument like the S&P 500 and then think of the leveraged ETF as a way of expressing an optimistic or pessimistic view on the underlying security. Doing an analysis on the leveraged ETF, I think, introduces a lot of unintended consequences you probably don't want to deal with. Final question. Jonathan Krinsky mentioned a breadth thrust on the May 30th episode. How does that work? So I brought up my chart of what's called the Zweig breadth thrust, and I will tell you, if you go back to the interview I had with Jonathan Krinsky on May 30th, we did talk about the breadth thrust. I don't think we were talking about the Zweig breadth thrust in particular, but I may be wrong. Because two things. The Zweig breadth thrust is a breadth thrust indicator created by Marty Zweig. There are other versions of this breadth thrust. I will explain to you what it's actually trying to do. So the concept of a breadth thrust, and this is the daily chart. So let me zoom into like the last year, and we can zoom into a little more recent. All right, so this is the last time the Zweig breadth thrust was occurred. A breadth thrust, generally speaking, is when the breadth is very negative, right? Meaning the market's probably going down, and most stocks are going down too. And then in a compressed period of time, the breadth goes from very weak to very strong. The reason why this is called a breadth thrust, and the reason why Marty Zweig capitalized on this, was he found that early on in a new bull phase, you often get a breadth thrust right at the beginning, right? The breadth is really negative, and you can see August, September, October, the trend was down for the S&P 500. A lot of breadth indicators were quite negative. Then all of a sudden, in a very short period of time, the breadth spiked, and within about a week or two, the indicator that I'll explain here in a moment went from very weak to very strong. Marty Zweig particularly looked at the percent of New York Stock Exchange listings that were advancing as a percentage of the total, and he would do a 10-day exponential moving average of that percentage, and basically would need to see it go from 0.4 to over 0.62 or 0.63 within 10 trading days. That's the actual description. If what I just said, you missed it, go to the upper right corner, click on search, and type Zweig breadth thrust. We have a great article that explains this in a little more detail. I've got some videos that break it down as well. But basically, the concept of a breadth thrust is breadth is very weak. In a short period of time, breadth becomes very strong. This spike to 1 basically shows where that Zweig breadth thrust was confirmed. You can see that was just the beginning. That was the first week in November, which is why it's such an important buy signal to look for after a decline. So the breadth thrust is not really meaningful right about now because we haven't had enough of a weakness to really initiate the signal. We need to have negative breadth first. We almost got one in early May where the Zweig breadth thrust indicator was below 0.4. It didn't get above 0.63 within 10 trading days, which is why it didn't formally signal. But as I go back to the last, 25 years, you can see that when the breadth thrust happens, it's usually after a bit of a decline, and usually right afterwards is a really bullish time for stocks. And that's why breadth thrusts are so important to look for. After a downtrend phase, look for those breadth thrusts to signal a new uptrend phase. And I think that's what Jonathan and I were talking about, was the strength off of those previous lows. Folks, that's it for our mailbag episode. Again, thanks so much for sending in all your thoughtful questions. Keep them coming to the final bar at Stockcharts.com. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great weekend.